What's up, guys? Michael Key, investment advisor with EKC Financial Solutions. So today I want to talk about a topic that kind of hits on what I was saying in my last video when I ripped on day trading a little bit. And if you watched that video, you would have seen that I said no day trader is wealthier than Warren Buffett. What is the difference between the two? Well, Warren Buffett's an investor. Day traders are speculators. If you go and you look up all the hedge fund managers and mutual fund managers, more times, if not 100% of the time, they're going to talk to you about fundamental research that influence their decisions in investing. GameStop and AMC, Wall Street Bet's finest, took place, and it was crazy. And good for you if you were involved in that, by the way. But let's be honest. GameStop was doing terrible as a business. AMC, when COVID hit, had no business. And when you're investing money into stocks, you're buying an ownership portion of that company. And I don't think a lot of people understand that. You're buying ownership in the company. You even get voting rights with some of the shares you buy. So if you're going to buy ownership in a company, theoretically, you would want to buy ownership in a good company, right? Unless you had direct influence on the daily dealings with that company, you wouldn't want to buy a failing company that's not profitable because you can't turn it around. So when you are investing your money, if you're going to go and you're going to invest in the stock market, you need to think about that. You need to think, of all the risk I have to deal with the stock market and all the unknowns. We have the infrastructure bill they're trying to pass. We have inflation. We have COVID. We have all these different risks, along with all the little technical stuff. How can I reduce that risk and get the returns that I want in the time that I want to do it? Well, you start by reducing the risk that you can control, and that is your investment decisions, what companies you choose to buy. And how do you go about choosing the ones you choose to buy? Well, the ones that have a great business model to start with. And investing in companies that have a growing business and a sustainable business is going to help you when you have a COVID-19 pandemic or a inflation problem or whatever other market risks, right? Because they're going to either be able to adjust or maybe their model even benefits in a time like that. Like we saw Amazon, great example. Amazon has been extremely innovative in their business as far as getting products to people. The way they sell stuff online, they sell everything. You can buy anything on Amazon, and a lot of times you get it there in the same day. It's extremely innovative. And then when COVID hits, everyone's having to buy stuff online, and it benefited them. It worked out for them. So, having that was a great opportunity. And yeah, even though you had the market risk during COVID, you had everything pulled back, and yeah, Amazon lost. It took off again because they were benefiting from everything going on in the country. And what are some of these metrics? What determines if a business is what you think it is? If you think it's going to grow, if you think it's a safer investment, well, go and look at their financials for one. You have certain fundamental and ratios you can look at if you wanted to do it just in a quick matter. The other thing too is that these publicly traded companies have all their information out there. You can go on the SEC website and look up all of their annual reports. You can look up how many shares the owners own, how many shares they sell. You can look up everything. It's all public knowledge. So, and if you want to know their annual report, it's a 10K. The 10Q is the quarterly report. You can go back and look at their earnings. What I look for, to start with, I want a chart. The only time I look at any kind of technical chart stuff, I want to see a long-term chart that's like that over time. It's going to be up and down, but over time, I'm seeing growth because I don't know 100% if past performance is going to be indicative of future returns, but I do know that I have a better chance of, I like my odds of it going up if I see a chart like that than if I saw one that was, just whatever. So that's a good place to start. But as far as the fundamentals and why it has that consistency, you can look at, what are the earnings every quarter or every year? Are there earnings increases? And not just revenue, but are there margins? What are their margins? If a company's operating margin, which is the profit they're making from their operations, their actual business, if that's above like 25%, then they probably have, depending on what industry it is, it's different for every industry, but, the higher the margin, the more of a competitive advantage they have. If they have a high net income margin, they're making money. And they have to be making money. You have companies that have a lot of revenue, but they may be losing. Now, some that are newer may be adjusting and they're getting their, those margins will increase over time, and that's what you want to see. But it's all about profit. Profit is the money that they retain at the end of the day. Free cash flow is a big one. The more free cash flow a company has, the more solvent they will be. The more reliable. If they had to pay off any debt, they could go and pay it off. And the more reliable they are to pay dividends. You don't want to invest in a company that, they may be paying a 6% dividend, but they may miss it sometimes. You want a reliable dividend payout because that's a reliable source of income. So, companies that have been around, companies that are maybe in an industry that's growing. We have the whole electric vehicle market growing. Obviously, that's a very new industry, and so you're probably going to see a lot of changes over time. But if you wanted to take a gamble, I'd say that if you looked at the companies, the ones that are doing good business right now are going to have an advantage in the future with growth because they're going to be able to adjust a lot easier. They're going to be able to adapt. They're not going to have to worry about certain debt. Maybe they don't need to take out debt, as much debt as other companies, because with debt is an interest payment. And that brings me to the next metric you can look at. You have what's called the current ratio. You can look at total debt to equity. You can look at a few different measures that will tell you, okay, if a company has a current ratio of 1 or higher, that means they have more current assets than they do current liabilities. If a company has a lower debt to equity ratio, that means they don't have as much debt, and it's going to be easier for them to pay off the debt if they needed to. If they're, having capital expenditures, that means they're reinvesting in the business. I think I was looking at GM. On Yahoo Finance it said GM was undervalued. When I went and I looked at some of the income, I believe it was GM, their income came from sale of property or stock buybacks, share buybacks, I think it was. And they actually lost money on the business operations. Well, I don't like seeing that because I want to see them making money from their business. And all that ties in together. So going and learning how to read the financial statements, everyone from what I've seen, will evaluate them differently. And if you went and listened to some of these hedge fund guys on why they make certain decisions, like they shorted GameStop. Hedge funds were really short on GameStop because it was a terrible company. And if you took a bet, more times than not, it was going to go down. And I'm not getting into the fact of all the other, crazy things that happen, but they only make decisions based off of the fundamental research that they do, the business itself. They don't care about the technicals because they don't know what the technicals are going to be. If you have a chart going up like this steady with great financials and it's a great business, they're innovating, they're doing everything right, then while you don't know what's going to happen in the future, you're giving yourself a lot more confidence in the future outlook of your investment than if you were to invest in a company that has a crazy chart, worrying about the technicals, worrying about it going down because you don't know how far it could go down. And when earnings comes around or whatever, they're all over the place with earnings. They're not consistent. You just don't know what's going on with the business. And that is where the difference lies between someone like a Warren Buffett that invests in value against someone who is day trading and just trying to read a chart. And I've always said, until someone makes more money day trading than Warren Buffett is worth, then I'll look at maybe what they're doing on the technical end. But until then, I'm going to follow the model that's led to a lot of success that most of the industry professionals are making money with. If you like the video, hit like. Remember to subscribe. And if you have any questions, I'll put my email below. You can always email me and ask whatever questions, and I'll be sure to reply. Thank you.
Hi, I'm Michael Key, investment advisor with EKC Financial Solutions. Our goal on this channel is to bring you valuable content as it relates to finance and investing. As a disclosure, any information discussed on this channel is not a recommendation and should be viewed for educational purposes only. Thank you.